Applications of conditional probability. The team decided, you know what? We're not going to make this an easy. We're not making any of this easy on you. Applications of conditional probabilities. Let's take a look. So the probability of an event or an outcome, typically based on past performance, is a metric used to estimate the future likelihood of that outcome. It's taking me back to a horrible statistics class I took in college. While independent single event probabilities are essential to traders, they do not take into account related past events that may be relevant. See, in trading, there is some relevance to that. I'm going to explain this in a second. For that, we have to turn to a more specific version. Next slide, please. I'm glad the guys did this. Conditional probability is a way to look at the likelihood of an event in the context of known information. So given that the ground is wet, what is the probability that it rained? Given that the family has 4 children, what is the probability that they have 3 girls? Okay, these are just examples. Let's go to the next slide. So we get into kind of the complex math model that is too hard for us.
I've never seen that math model, but go ahead.
No, I know. We don't need to understand this, but there are a lot of tasty traders out there that are professors and that are really strong mathematicians and engineers that love to see the models behind everything. So this is just classic, right? Let's go to the next slide.
You do the parentheses first, right? In this example?
Always do the parentheses first.
Right. Got it.
Yeah.
Got it.
He's kidding, Beth. So what are some applications? One application is comparing returns of one stock conditioned on another. So like a pairs trade, let's just say, Qs and SPY. Given that the SPY has a positive return, what is the probability that the QQQ would have a positive return on a given day? Notice we didn't say IWM here, because if we said IWM, it would be no, there's no chance that they're the same thing. But in a different world, it's possible.
In a different universe, yes.
In a different universe. So the Qs and the SPYs have, if the Qs are up, the SPYs are probably up. So we can solve this using a formula for conditional probability. Next slide, please. So first we measure how often the SPY has positive returns while the Q has positive returns. And from a conditional probability formula, where we basically take the formula that we showed you on the last page, it would equal about 87% of the time. So 87% of the time when the Qs are up, the SPYs are up. We would expect this since these assets are highly correlated. All right. And so for us, okay, this makes total sense. Like, I don't think there's anybody listening to this that would say, oh, that's a ridiculous number.
Sure.
That 87% of the time when the SPYs are up, the Qs are up. When the Qs are up, the SPYs are up. Let's go to the next slide.
Over time.
So positive option P&Ls. Now think about this for a second. Positive option P&Ls. Do they have a high probability of clustering? And the answer is yes. This means that if a trade is placed on day 1 and that trade is profitable at 21 DTE, there is a high likelihood that trades placed over the next 3 consecutive days will also be profitable upon management. Now, you don't know that at the time you place the trade, but we're just talking about conditional probabilities. If you place a trade on Monday and that trade turned out to be profitable, trades that you did in the same underlying on Tuesday, Wednesday, and Thursday would also turn out to be positive. So that's the whole point behind.
If in the same direction?
Yeah, the same exact trade, basically.
Oh, same exact trade. Gotcha.
But the whole reason for doing this, for having this discussion, is that's why we trade with high probability expected outcomes all the time, and if you trade every day with high probability expected outcome, you're going to hopefully generate a positive P&L. So given positive ending P&L for the trade placed today, what's the probability of a positive P&L for the trade placed tomorrow, the next 2 days, or the next 3 days? And you can see here, 94%, 90%, and 86%. That's what we want. If the first trade we make is a winner because we're doing something with high IV, whatever it is, then the next 2 trades we do right after that, we want those to be winners too. Mm-hmm. And there's statistically, based on conditional probability, a very high chance of that happening. But what if they're a loser? Next slide, Beth. So negative option P&Ls also have a relatively high probability of clustering. That's why when we lose, it's usually not just a standalone. but on a very short-term scale. So within 1 to 2 days of placing the first losing trade. So losses are generally isolated events and less predictable. But if you do trade on day one and then trade on day two, it's 75% chance the trade on day two is going to be a loser, 62% chance on day three, and then over the next 3 days after that, it goes down to 50-50. The point here is, and this is a very interesting takeaway, that based on conditional probability, trades that are winners made over multiple days, that turn out to be winners, but made over multiple days, they have a much better chance of being winners than losing trades made over multiple days, because losing trades are much less predictable than winning trades, and losing trades are isolated events. So then how do you lose? You lose when you get outlier moves, right? That do outlier moves that do. The reason you have a high probability.
This goes counter to adding to your winners.
No, the reason you have the reason you do high probability trades is you do high probability trades because you want the really good chance of success for all these reasons. But the negative side to high probability trades is that many times you have unlimited risk. So the problem with unlimited risk is that when you're wrong and then you have multiple days in a row, that's the challenge. And those have to be short-lived. But the fact that you have unlimited risk equalizes or offsets the consecutive positive days. And that's the whole reason that the mechanics are so important about finding the high probability trades, things like that, or finding the high implied volatility and things like that. Let's go to the next slide. It's complicated, but it all makes sense. While probabilities for single events are meaningful, they don't take into account the history of related events. So conditional probability does take relationships into account. It allows us to calculate the likelihood of an outcome given the previous outcomes. Positive P&Ls tend to cluster, meaning that trades placed on consecutive days tend to be positive if the first trade's positive upon management. Negative P&Ls only tend to cluster on short timescales. So, that's just a question of, this is the whole reason for staying small and trading often.
Got it.
Because the risk is the big outlier moves to the downside, and that's it.
Very good, sir. A little complicated. Thank you for the takeaway. I'm going to have to go back and look at it one more time. We're going to take a quick 90-second break and come back. We got more Tasty Live after this with the opening bell.